Good afternoon, everyone. Welcome to Self-Directed IRA Saturday. I'm Steve Sabaji, one of the IRA specialists on our sales team, and I'm coming to you live from our office in Austin, Texas. So we have a very special presentation. This is a first-time presenter with us, somebody who I've gotten to know pretty well over the last several years. His name is Joel Fine, and he's going to be talking with us today about syndicating deals for yourself. He calls it Syndication 101. I've seen it before. It's a very good presentation, and I think you're going to enjoy it a lot. But before we begin, I just want to start with a brief presentation for us here on Quest Trust Company and some of the things that we do. We'll just kind of start with the basics. We'll start with talking about who we are, and there we are. So, Quest Trust Company. We are the largest self-directed IRA custodian in the state of Texas and one of the largest in the country. We have at this point over 20,000 active investors in our client base that are nationwide. We also have at this point in excess of $2 billion under administration through our organization and over 100 employees, many of whom are certified IRA specialist professionals. This is a designation that's given by the American Banking Association, and it shows a specific training and further education with regard to the topic of IRAs. Now, just a quick note as well, this presentation is purely for educational purposes, and anytime you're entering any transactions, please always remember, contact your tax, legal, or investment advisor. All right, so what is a self-directed IRA? Well, in point of fact, a self-directed IRA is no different than an IRA you would get anywhere else. In fact, you could say every IRA is self-directed because in a manner of speaking, you always get to choose the investment. Now, the distinction with a self-directed IRA, however, is that it lets you utilize a private asset, meaning something that you get to pick out. It's something that's not on a public exchange anywhere. You can't buy it through a Fidelity or a Charles Schwab. That includes a piece of property. That could be a partnership. It could be private lending. It could be private stock in a company. So it's a variety of different assets, again, that you just can't get publicly traded. Now, the benefits, there are many. First of all, it offers more in the way of diversification. You know, they always tell you in investment companies, don't put your eggs all in one basket. Well, the fact is that when it comes to investing in the market, you're going to find investment overlap no matter what. There are too many investors chasing too few securities. And so no matter what you do, you're always going to be coming up with the same stocks over time. By utilizing your self-directed IRA, you truly get to get into an asset class like real estate, something that doesn't correlate to the stock market on its own. So again, the value here is it can be doing well when something else is not doing as well. And it gives you that truer asset diversification. Tax savings, of course, IRAs offer across the board. There are some that are tax deductible. They're always tax deferred. And many of them offer tax-free income on distributions when they are qualified distributions. So if you want to know more about that, that's certainly something we can talk about. I like to think, too, that there's a little bit of a social investing element that comes along with a self-directed IRA. And here's what I mean by that. Think about what happens if you go and you renovate the rundown eyesore of a property in the neighborhood. You know, you're getting in on this investment, but what goes into that as well? Well, you got to do the renovations. That means you're hiring local people. You're sourcing the materials locally. In essence, you're stimulating the local economy by virtue of the activities that you're doing. So in effect, you're making it in a position where the community at large is going to be improving based on your investment. I like to think of it as doing good for others and doing good for yourself. And finally, the self-directed IRA, unlike anything else, lets you truly invest in what you know best. You're the one who's done the research. You're the one who found the asset. You know what the upside is because you've done all your homework. So the likelihood of being surprised is much lower here. So again, it goes hand in hand with that overall diversification. You get to pick the asset. Again, all those things working for you. Now, the types of accounts, they range from the personal, the employer plans, and the specialized plans. And again, I don't want to go into these too much. This is a very long conversation. We could have our own self-directed IRA Saturday on this alone. But under the personal side, you have the traditional, which is also known as the rollover in many cases, and then the Roth, where again, you can get tax-free income in retirement. The employer plans, there are several different there. They come with different characteristics, contribution levels, various other components that can be customized. And again, if you're a self-employed individual or small business owner, we can talk about how these can benefit you. Also, due to the fact that you can contribute much more to them than you could a traditional or a Roth. And then finally, the specialty plans, they allow you tax-free distributions for the special purposes that they offer, that being healthcare, that being education. So if you want to learn more, let's talk about it next week. Now, just in terms of the choices, I mentioned that you can get that broader diversification by investing in what you know. So that can be a variety of different things. Real estate in the proper sense, where it could be a fix and flip, it could be a rental property, entities. These are some of the things that Joel's going to talk about more. LLCs, partnerships, JVs, any of those kinds of entities that you can come up with. And then notes, lending, private lending. It's all private negotiation. You get to set the terms with a borrower and create your own investment that way. All right. Now, here at Quest, as you know, one of our key features here is the ongoing education and networking that we offer. So we will continue to have things like this class, the Self-Directed IRA Saturday, where we do these live. We will have ongoing webinars during the week. We also have our virtual happy hour, which will be coming back. And then, of course, if you ever miss anything, all of these things are archived on our YouTube channel and our Facebook page. So if you ever missed something that you looked interesting, please go ahead and look us up on those platforms and you'll be able to find our information. Now, we've also started to do live events and we'll continue to do so as long as possible, unless, something else happens in this world. But our self-directed IRA social, it takes place every first, second, and third Tuesday of the month. First week is Houston, second, Austin. The third week will be in Dallas. And that fourth week is now when we will have our virtual happy hour. So please, if you're in the area, register, check it out. It's going to be food and drink. It's going to be education and networking. So a great opportunity to meet like-minded investors. Now, we also have our referral program in place still. So if you refer a client to us, you can get a $25 credit toward your IRA, and the individual you refer also gets $25 off their account opening fee, normally $100. And it's a benefit that you can use on and on. There's no cap to how many times you can take advantage of this. So the more you refer, the more you get. I've had a lot of my clients taking advantage of this. And again, it's a win-win for us all. All right. We will be having one of our big events coming up shortly. This is going to be the Self-Directed IRA Social for the month of March. It's going to feature the home run deals that people have put together in the recent past. So it's kind of a competition where people will come in, they'll talk to you about the various projects that they've done, and you as the audience get to vote as to who had the best deal. So again, check out our website, please register and please come. We'd love to have you here. Now, we also here in Austin are going to start going back to San Antonio. We can't wait. So those of you who are down in that area, we will be coming back by popular demand. So we have this coming up. It'll be late March. Hope to see you there. And finally, the Expo for Quest. That's another long event that we've had, a long time event, third year in a row. It's going to be a weekend of networking, education, some of the brightest minds in the real estate field. We'll talk about some of the tried and true methods of investing, and plus put a new twist on several things that you've seen before. But more than anything, it's a great opportunity for you to find a way to build out your team. And what I mean by that is there are going to be plenty of vendors who assist with the needs that you would have with real estate investing and can help you be successful in what you're looking to do. All right. So wrapping up here, please, if you want to reach out, if you want to get in touch with us, a couple of different ways you can go. Use that QR code that will scan to the Calendly schedule for the IRA specialists. All you have to do is hit the calendar, plug in a time that works for you, and we will call you. You can always reach us through our chat box. Just give us a straight up phone call on our toll-free number. And we also have an email box as well. So we hope to hear from you soon. At this point, I am going to turn it over now to Joel in just 1 second here. Joel, how are you today?
I'm great, Steve. How are you?
Very well, thanks. All right. Just as a way of a quick introduction, Joel, he relocated to Texas from Silicon Valley. This was about 2 years ago, I think, that he made the trek here. And he's now focused full time on investing and doing syndication deals in the area. Joel, on a personal note, he has 4 kids, and they are spread across the country, all in 4 different states. And he now lives in Leander, Texas, which is just a little outside of Austin. And he lives with his lovely and his highly supportive wife. So before I turn it over to Joel, I just want to say that in terms of how we're going to do this today, it's always best that we compile the questions in the chat box. We will do them all at the end with Joel. So please feel free to load up the chat box and give us your questions, and we will take them all at the end. All right, Joel, I'm going to turn it over to you, and I will see you at the very end for Q&A.
Sounds good. Thank you very much, Steve. And thank you to the Quest team for giving me this opportunity to talk to your audience. My goal today is to introduce you to a financial tool called Syndications, and to help you understand it well enough so that you can decide whether that can help you diversify your portfolio into potentially a new asset class, such as commercial real estate. So again, my name is Joel Fine. I'm with Lakeline Properties. A little bit about me. I was trained in college as an engineer, and I had a career for a long time as an engineer, project manager, executive, and eventually entrepreneur. Towards the end of that career, I started investing part-time in real estate as a side gig. Went full-time into real estate a couple of years ago, right about the same time that I moved from California to Texas. Since then, I've sponsored 8 deals, totaling about 1,500 doors of multifamily assets, along with 30 acres of ground-up development projects in the Austin and Houston areas. I'm also a passive investor in more than 30 deals, totaling about 11,000 doors and 440 acres of ground-up development. So let me introduce this by just talking about an important myth about commercial real estate and maybe busting that myth. So the myth that I want to talk about is that owning large-scale commercial real estate is really out of reach unless you are ultra wealthy, or if you work at it full time, or maybe both. That's not true, though. The truth is that ordinary investors can own commercial real estate. They can do so using the investment vehicle that we're going to talk about today, called a syndication. And using syndications, ordinary investors can invest in pretty much any real estate asset class, running from apartment complexes through office buildings, hotels, self-storage facilities, retail, long list of others. But really, it's a broad category. And syndications can also bring into reach pretty much any size of asset. So for example, I recently invested as a passive investor in a mixed-use redevelopment project spanning 75 acres, 2,600 multifamily apartments, retail and hotel. I'm a small part of that deal, so I really didn't have to commit a lot of money to that, but it enabled me, through the power of syndication, to invest in that large asset. Typically, the minimum investment is going to be about $50,000, but could be less. I've seen syndications down in the $25,000 to $35,000 range. So, how might you invest in commercial real estate? There's active, what I call semi-passive, and passive options. So active is, hey, you buy a house, you fix it up, you go find the tenant, and you manage the property. So if there's repairs that need to be done, the tenant calls you, and you go deal with the contractor to get it fixed. That's going to be very time consuming and really take a lot of your focus. So suppose you want to have a little bit less time spent on the property. You want to redirect your focus elsewhere. You could do something a little bit more passive, but it's not truly passive. And that is to do exactly what I just described, but hire a third-party property manager to manage the property. That sounds good. It sounds like it's got the potential to be passive, but still it isn't fully passive because that property manager is going to have to be interacting with you on a fairly regular basis to make decisions about what to do. For example, if a repair is required, what bids to get or what decisions to make about how to move forward with the repairs. Or you could go fully passive by investing in syndications, and that's what I'm going to drill down on today. As an investor in a syndication, your time commitment is truly minimal. So first, let me define what a syndication is. At its core, a syndication is a group of people who get together to buy an asset. And usually it's real estate, but it isn't always. Typically, it's an asset, that's bigger than any one investor could buy. But even if an individual investor, let's say you could afford the asset in question, it may make sense for you to buy it in partnership with others so that you can diversify your investments across many assets. So a little more about the partnership. In the partnership that comprises a syndication, not every partner has the same role. Some partners put up money to make the purchase, and they're the passive investors. And other partners are active. They run the deal. They do the work to make the deal happen. The partners that run the deal, that are doing the work, typically also put money into the deal so that they have skin in the game. And I'll talk about this in more detail, but what that does is it allows everybody's interests to be aligned because both the active and the passive partners have significant money at stake in the success of and the outcome of the deal. So a bit more detail about the roles of a syndication. Again, the general partners, also called sponsors or active investors, they make the deal happen. And what I mean by that is they find the property, they get it under contract, they arrange for bank financing, they would typically conduct due diligence, meaning a detailed inspection of the property to understand what the condition of the property is and any work that needs to be done on the property to improve it. The active investors, the sponsors, will put up risk capital to cover the expenses that are incurred before closing. Those are things like legal fees, closing costs, earnest money deposits, and so forth. And then finally, the general partners, the active investors, sign on the loan. That's all part of making the deal happen. Then beyond that, once the deal closes, once the property is purchased, the general partners are going to manage the asset. And what that means is they're going to do the work to manage the property manager that's on site, make day-to-day decisions about the business plan, decide what sort of renovations might happen, if and when to move forward on evictions, what to do about staffing openings that happen on the property, and so forth. So managing the asset actually takes a lot of work, and that's what the general partners take care of. And finally, after the business plan is executed, perhaps the renovations are complete or the tenant base is turned over and the property is running more smoothly than when it was purchased, the general partners will decide when or whether to either refinance or sell the asset. On the other hand, the limited partners, the passive investors, have a very different role in this partnership. Their role is very, very limited, hence the term limited partners, they send a check initially to help fund the deal. And again, the typical minimum is going to be in the range of $50,000 to $100,000. And that's it. After that, they collect dividend checks and potentially a capital event. When the property is sold, they'll collect their equity and any profits from the deal. Beyond that, limited partners essentially have no specific role. The great thing about syndications here is that the general partners and the limited partners share in the rewards. So assuming that the general partners follow through on their business plan and it goes according to plan, there will be profits that are available for the general and limited partners to share. So the syndications that I'm most familiar with and that I think are fairly typical is what you might call a value-add multifamily syndication. In a value-add multifamily investment, the group, the partnership, purchases an apartment complex that needs work in some way. Maybe it needs renovations, maybe it needs some repairs that haven't been done in a while. Perhaps it's being poorly managed, and so the management team that's running the property needs to be swapped out. Or maybe there's some tenant issues. Delinquencies are not uncommon in apartment complexes that need work. And so it may be the business plan may involve an upgrade to the tenant base. This is really similar to a fix and flip for a single family home, but on a larger scale. If you think of a single family home that's maybe in a bit of disrepair and needs some work, you fix it up and you can sell it for a profit. That's really, when you scale it up, that's what a value-add multifamily investment looks like. So some nice things about value-add multifamily is during the renovations, you're typically continuing to collect rent from occupied units. Most properties like this, you'll be renovating, say, a handful of units while the other units are still occupied. And there'll be organic vacancies, turnover in the units where some tenants are moving out, new tenants are moving in all the time. And so you do a rolling renovation across the property. But again, while you're renovating, the units that are occupied continue to pay rent, and that gives you cash flow that you can use to distribute to your investors. As the property has improved, often the business plan involves an increase in the rents and perhaps a reduction in expenses. Another benefit is that the syndication can use a financial tool, a tax tool called depreciation, to write off the value of the asset, and that can have the effect of reducing the tax impact of profits from the investment. At the end of the investment, in say 3 to 5 years, the improved income, the higher net operating income, will result in a more valuable property, a property that somebody else will buy for a higher price than the partnership bought it for in the first place. So at that point, the partnership can sell the asset for a profit and realize the appreciation. So to recap some of the financial benefits here, we've got cash flow from the ongoing rent collection, appreciation from the improvement in operating income, and depreciation from the tax write-off. Now, these three benefits apply to all real estate, but now with syndications, we can go beyond that and get the benefit of diversification. If you buy a single family home, that may be enough of an investment that you really can't buy a lot of them to diversify. But with syndications, the investment can be a more modest amount, and you can diversify across many different deals, different locations. For example, you can invest in syndications in multiple states. You can invest in different asset classes, investing in apartments, retail, office, self-storage, hospitality, a variety of asset classes across which one can diversify. Property ages. You can invest in older and younger properties, properties that need more or less work. And of course, the size of the property is another way you can diversify. So by investing in syndications, you can spread your money across many different opportunities and thereby capture the risk mitigation that diversification offers. So how does a syndication work financially? Well, at the highest level, the general partners and the limited partners are going to share in the profits. This has the beneficial effect of aligning everybody's interests. In other words, if the deal does well, then there's more profit available to distribute to both the limited partners and the general partners. If the deal does poorly, then both LPs and GPs get fewer profits. So the GPs are highly motivated to do a good job on the deal, to make the deal run well, so that there's more profit available to the GP as well as to the LP. One common structure of the financial split, as it's called, might be a preferred return, which goes to the LPs first before any other profits are split, and then a percentage split called a 70-30 split. Now, these numbers can vary on different deals, but this is a fairly common one. So again, on a 7% pref and a 70-30 split, what that would mean is limited partners, LPs, get 7% per year cash return on their invested capital, and then anything left over gets split 70% to LPs and 30% to GPs. There's a lot of variations on these splits, and every syndication is likely to be a little bit different. The pref can be larger or smaller, or sometimes there can be no pref at all. The 70-30 split can be adjusted to be more or less favorable to the LP. Could be 80-20, could be 60-40. A variety of numbers could be applied. It can also get more complicated. There's a concept known as a waterfall return, such that once the return to the limited partner hits a threshold, the split adjusts and generally becomes more favorable towards the GP. And what that does is it intensifies the incentive for the GP to achieve some particular financial target. For example, a deal might be structured with a 7% pref, a 70-30 split, and then once the LP gets a 20% return, the split goes to 50-50, which means once the LP gets 20% on their money on an annualized basis, the GP gets a greater fraction of the splits. Again, this incentivizes the GP to go over and above the business plan and really make the deal excel. So here's what some sample LP returns might look like. And this is what I'm going to talk about is after the general partner share is taken out. So it's not unusual for, and these would be projections, an 8% cash dividend, and then a 70% equity increase on the sale of the asset. So what that would mean is on let's say $100,000 limited partnership investment, that would return $8,000 per year in dividends. And then after say 3 to 5 years, $170,000 payback from that $100,000 investment. Again, this is just a sample set of numbers. Every deal is going to vary in some way. But what I'm showing below at the bottom here is what the cash flow might look like for a deal like this. And in particular, you might notice that the year one cash flow, so year zero, that's when the investor puts in $100,000. That's why it's in red. In year one, there might be a smaller dividend payment. This is because in the early years of a deal, that's when the renovation is happening at its most intense. So that means that the partnership is putting most of the profits back into the property to improve it. So there might be a relatively small payout, or perhaps even no payout in the first year. And then in the second through later years, the payout would improve and become something stronger and more steady once the renovation plan is complete and we're now just into maintenance mode. So at the very end, in year 5, you might see a $10,000 dividend payment, and then on sale of the asset, a $170,000 return to the investor. So a typical timeline on a syndication deal, maybe 2 to 3 months before the closing of the deal, the general partners get the deal under contract and share information about the deal with their investors. Within 1 month before closing, investors or limited partners would be asked to commit to the investment and wire their money or send their money in to fund the investment. At month 0, that's when the closing takes place, and the partnership now owns the property. Over the following year to year and a half, that's when the general partners would execute the value add plan. That's when they would do the renovations and repairs, perhaps turn over the tenant base and so forth. Over the following year to year and a half, that's when the GPs aim to stabilize the property and to demonstrate solid, consistent, and improved financial performance. Sometime after that point, that's when syndications typically close out. So they sell, distribute profits, and wind down. Not every syndication is going to do this. Some syndications exist for long-term cash flow, but the syndications that I do and most of the syndications that I see, they're really intended to be, again, fix and flip model, where the fix takes place early on in the life of the deal. We then improve the net operating income, the performance of the property, and then we look to sell so that we can then redeploy the capital into the next deal, where we can, again, do renovations and improvements. So legally, here's how the structure might look. The syndication at the top level is comprised of limited partners and general partners. Those are the people that are involved. But if you start from the bottom, the property itself is actually not owned by any people. It's owned by an LLC. That LLC is the LLC that is the partnership owned jointly by the LPs and the GPs. So LPs own shares in that LLC. They don't own the real estate directly. They own shares in the LLC. And that's important for a reason that I'll go into a little more detail later. There's a second LLC that's typically created in a structure like this called the managing LLC. The managing LLC is the entity that controls the owning LLC. It's a little bit complicated, but what that means is that the general partners who own the managing LLC make decisions about the property through their control of the owning LLC. All of this is going to be defined in fairly complicated, lengthy legal documents that LPs have an opportunity to review and will have to sign before making the investment. So these legal documents are a very important element of every syndication. So some of the rules around syndications. Syndications are going to be governed by those legal documents I just referred to. And in particular, pretty much every syndication is going to include an operating agreement, a subscription agreement, and a private placement memorandum. That combination of documents do a number of things. First, they define the business and legal relationship between the LPs, the GPs, and the property ownership. Those documents will define the financial terms, so specifically how the profits are split. So referring back to my earlier discussion about whether there's a pref or not, whether it's a 70-30 split between the LPs and the GPs or some other number, whether there's a waterfall, all of those terms will be defined in detail in these legal documents. These legal documents also will articulate the risks. And it's important to understand that these are not risk-free investments. And every syndicator, every GP should make that clear when discussing and sharing information about any of these syndications with potential investors. So there's a number of risks, and those risks will be articulated in these legal documents. These legal documents often, but not always, will also share financial projections. And again, just as it's important to acknowledge that there are risks in these investments, it's also important to acknowledge that the financial projections are only projections and are not guaranteed. Other important rules about syndications: because the investors, the LPs, aren't owning the real estate directly, but are instead owning shares in an LLC, that makes them securities, legally speaking, which means rules that are set by the Securities and Exchange Commission, SEC, apply. These rules include the following. In most cases, limited partners must have a pre-existing relationship with the general partner. That means you and the general partner, you if you're a limited partner, have to know one another, have to have had conversations so that you know enough about the general partner to know whether you can trust them with your money. And the general partner has to know enough about you to know whether it's a suitable investment for your financial situation. In addition, limited partners have to have some level of knowledge about the investment. They need to be either accredited or sophisticated, and those terms have very specific definitions according to the SEC. To be accredited, an investor has to have one of the following two things be true: either $200,000 annual income, or $300,000 if you include your spouse, or $1 million or greater net worth, not counting the home. Now, accredited is a term of art. Some people read that and they think, oh, does that mean I need to pass a test or take a class? No, it doesn't. In this context, the SEC has defined it to be only those financial metrics. There are a few other ways to become accredited, but these are the simplest and most common. So again, you need to be either accredited or sophisticated. If you're not accredited, sophisticated is a little bit more loosely defined, but it means that you need to be knowledgeable enough about investments to make an informed decision about this particular investment. So again, in order to invest in a syndication, most syndications are structured such that every limited partner needs to be either accredited or sophisticated. One other useful fact about syndications is you can use retirement money, IRA money. So as an LP, you can invest using either post-tax money, meaning just regular savings, or tax-deferred money. Investing with an IRA is not difficult, but you'll need to take a few steps. You can either set up a self-directed IRA or a solo 401k. And our host for this session, Quest Trust, I'm sure would be happy to help you with this process. But with a self-directed IRA, as Steve mentioned earlier, you would need to find a custodian, set up an account with them, either invest directly with savings, or roll over an existing IRA or a 401k from a previous employer. At that point, once you've funded the self-directed IRA, you'll get the custodian involved. So if there's a particular syndication you're interested in investing in, you'll bring the custodian into the conversation, share documents with the custodian, and the custodian will facilitate the transaction on your behalf. With a solo 401k, the setup might be considered a little bit more complicated, but again, you roll over existing funds and now you've got more control. There's no custodian involved. You can invest directly from the solo 401k as an investing entity. There are some complexities and subtleties to doing this when you use IRA money or solo 401k money. So I'd encourage you to consult your tax professional for guidance on this. So walking through at a very high level an example of a deal, this is one that I actually am involved in, did do. So Ventura Apartments, we purchased a 42-unit apartment complex in Austin, Texas in April of last year, so a little bit less than a year ago. The purchase price, or the uses, the money that we needed to get the transaction done, included the purchase price of $4.7 million, a renovation budget of $700,000, which in our business plan had a fairly detailed allocation between units, interiors, things like appliances, flooring, countertops, paint, and so forth, and exteriors such as landscape improvements and the like. And then closing costs and working capital. So the combination of all of that added up to $5.9 million. That's what we needed in order to close the transaction, was $5.9 million. So the sources, where we got the money to close the transaction, was the majority of it came from a bank loan of $4 million. And then our limited partners came in with $1.9 million of equity. And again, in a typical syndication, and in this syndication, the general partners also served as limited partners. In other words, we came in with some of our own personal funds to purchase limited partner shares. So some of the 1.9 million came from the general partners, but it's still considered limited partner equity. So the total of the sources is 5.9 million. That matches the uses of 5.9 million. So we were able to close the deal, purchase the property, and initiate our renovation plan. In that deal, since it's almost a year ago now, we've got a little bit of experience with that. We raised the rents from $950 a month to $1,275 a month after we did the renovations. We had projected 1,100, so this this means our financial returns are actually better than we had anticipated. The higher income from the increased rents, going from 950 to even the 1,100 projections, but even better, the 1,275, will lead to increased net operating income, which in turn leads to an increased resale value. Our plan was to sell after 5 years for $7.4 million versus our purchase price of 4.7 plus the renovations and so forth. So really the profit was 5.9 million, 7.4 million minus the 5.9. But given that our rents are higher than we projected, it's likely that we'll get more money for the property, and it's likely we'll be able to sell sooner. Again, I say likely. Nothing in this business is guaranteed until it happens, but we're optimistic about it. And so our projected returns from our initial projection was that a $100,000 investment would get back a total of $177,000 in dividends and sale proceeds over the course of 5 years. And again, that will vary, that will change due to the difference in between our projections and the actual performance of the property. Some things I want to emphasize, some important considerations about syndications. Syndications are not liquid. Once an LP is in a syndication, the LP cannot sell their shares midstream. They're in it for the long haul. They're in it until the GPs decide to sell the property and close down the syndication. Now, the GP is motivated to do that, is motivated to execute their business plan as quickly as possible. So it's not likely that you'll be stuck in the investment longer than anticipated, but it is something to be aware of. Again, these are not risk-free investments. An LP can lose some or even all of their money if a deal goes poorly. And a good GP will disclose all of the risks that they can think of, but also will do very careful due diligence going into the deal and develop backup strategies to mitigate those risks. And again, to emphasize, the LPs are passive, so they don't have control of the decisions or the timeline around the property. In particular, the general partners will be operating the property, making decisions about how much money to put back in the property, to renovate, to conduct repairs, whether and when to replace the third-party property manager, and so forth. And then ultimately, the decision about when or whether to sell will be in the hands of the GPs. Again, the GPs are motivated to sell as quickly as they can within the business plan so that they can realize their returns and redeploy the capital into the next deal. But the LPs do not have control of this. And so it's important to understand going in that, again, it's illiquid. You're in it for the long haul. There are risks, and you don't have control of those decisions. So to summarize, once again, a syndication is a kind of partnership that is formed to purchase an asset. Often that asset is real estate, such as a multifamily apartment property. The general partners, also known as the active investors or the sponsors, organize the deal, operate the property, make decisions, and decide when to disposition or sell the property. The limited partners, also known as passive investors, put their money into the deal but are otherwise passive. And the general partners and limited partners share in the profits so as to align everyone's interests. Limited partners can use tax-deferred money from IRAs or 401ks. There is a minimum investment. That minimum is typically in the $50,000 range, but can be more or less depending on the syndication. The financial benefits of syndication include cash flow, appreciation, depreciation, and diversification. And as an LP, if you choose to get into an investment like this, you are truly passive. No responsibilities or effort required. Really only one decision is required, and that's the decision early on to get into the deal. After that, it's all passive. And with that, I will turn it over to Steve to moderate some questions for us.
All right. Well, thank you, Joel. That was very informative. That was a lot of information, and there have been a lot of questions coming in through the chat. So let me start at the top. Let's see. Oh, we did just clarify. Doors is the term for units, and typically these are apartment complexes, correct? But these types of deals can be a variety of different things, can they not?
Yes, and doors really applies to apartment complexes or multifamily
Right.
properties.
Yeah.
There are other metrics to apply to, let's say, retail or office space. Those are typically measured in terms of unit square feet.
Okay.
Storage facilities might be just in terms of units as well. So yeah, every type of asset class is going to have its own metric to measure it.
Got it. Okay. Question that we had about average termination of a syndication. So how long do these deals typically go?
So most syndications are going to be in the range of 3 to 5 years. I see some that are 5 to 7. And again, that's the projection starting out. Then it's going to depend on how well the business plan executes. And it may also depend on economic variables that are out of any syndicator's control, such as the value of properties, the market appreciation, interest rates, and so forth. So the target is 3 to 5 years, but that will vary as the business plan is executed.
Yeah, I remember you saying that just recently that the 3 to 5 is very common. I'm just curious because I have heard people tell me that the syndication deals were designed to be longer. I mean, do you see that as not, I don't want to say riskier, but is that out of the ordinary, or is really 5 years a good time to shoot for? Or you said they like to turn around their deals as quickly as possible.
Yeah, the aim is going to be to go faster than the 3 to 5 year target, but it typically takes a good year and a half to 2 years to execute the renovation play, because you're renovating a few units at a time. You're waiting for tenants to move out. You don't want to force tenants to move out just so you can renovate. You'd rather have most of the property occupied while your crews are busy on, let's say, in the range of 3 to 10% of the units at any one time. So it's going to take a while to renovate the property. After you're done renovating, it may take a little bit longer to reposition the property in terms of people's perception of it. People may have an opinion about the property based on the earlier condition when there was a lot of deferred maintenance and maybe it was a little run down and beat up. And so after you've renovated it, over time, people are going to get used to the idea that it's a nicer property. And so that'll help you get better tenants and higher rents. But you've got to be patient. You've got to let that play out. And so let's say you're going to spend a year and a half renovating, another year and a half letting the new positioning of the property take hold in the community's minds. That takes you to, say, 3 years.
Yeah.
Then maybe you want another year of great financial performance so you can show a potential buyer of the property, look what this property is capable of doing. At that point, in this 3 to 4 year time frame, that's when you can potentially sell. So again, 3 to 5 years. Most syndicators are going to try to be conservative in the sense that they'd like to overperform, meaning give you your returns sooner and better than they project. And so by calling it 5 years, that gives a little bit of room in case they can outperform those projections.
Got it. Okay. One question was, can you share any online tools or platforms that you use as the general partner to manage investor relations or LP distributions and management or compliance?
Yeah, so there's a lot of platforms out there. They're called investor portals. And each syndicator might have a different investor portal, but I'd say maybe 5 to 8 that are the most common in the industry. The one that I use is called Cashflow Portal. It's cashflowportal.com. And that particular portal, one nice thing about it is it's built to facilitate relationships between investors and syndicators so that a new investor who doesn't know any syndicators can go to that portal and find and identify some syndicators, reach out and develop those relationships. And that's really essential in the syndication process. As I mentioned, most syndications are structured in such a way that there needs to be a relationship between the syndicator and investor. So the investor portal I use helps with that, helps facilitate that relationship building. Great.
Now, another question. Why the separate LLCs versus single LLC with operating agreement detailing the managing members, ownership, etc.?
That's kind of outside my area of expertise. When it comes to how to structure the deal, I really follow the instructions of my SEC attorney. But really, pretty much every syndication is going to be structured that way, and I think it has to do with how the control and the ownership are divided. Control and ownership are not. There's not a one-to-one correspondence. In other words, the LPs own most of the deal because they get 70% plus of the profits, but they don't have control of the deal. And I think by splitting it that way, that facilitates, that makes it easier to separate out the control from the ownership.
Words to live by. Always listen to your SEC attorney.
Absolutely.
Yes. All right. What percentage range do you see GPs participating most often? For example, the equity needed. Is there a quote unquote common range you'd expect to see GPs contribute?
Yeah, in fact, that's a great question.
Yeah.
And what I see most often is out of the equity that's required, let's say there's a $2 million equity requirement to close a deal, in the range of 5 to 15% of that will come from the GPs. And oftentimes you'll actually find lenders who like GPs to invest in the deals, and in fact might require GPs to invest 5 to 10% as a minimum. And that way the lender can be confident that everyone's interests are aligned and that the GPs have significant personal financial wealth at stake, so that if the deal struggles, the GPs have even more motivation to help repair and fix it. So 5 to 15% is the range that I typically see, and a lot of lenders are going to require a minimum of 5 to 10% anyway.
All right, another one from the same person as before, and I think this is another great question. Is the ability to sell their shares always prohibited or defined in the LLC terms? This was obviously a big deal and a big concern last year with the Build Back Better bill and the potential impact that had. So what do you see there, Joel?
Yeah, so typically the controlling documents are going to say that only certain exceptions are allowed for transfer of shares. So for example, if an investor dies, the shares become part of that investor's estate, and then there's pretty much no choice. Somebody new has to come along and own those shares. There are other situations like divorce, financial hardship, bankruptcy, where there are specific legal obligations and legal parameters within which transfers can take place. It's not a trivial matter, because the process of agreeing to the terms of the syndication is somewhat involved. There's all these documents that define the legal relationship, the disclosure of risks, the personal relationship that the syndicator has to have with the investor. All of those things, as the investor is initially making the investment, there's time to do due diligence to make sure all of those things are adhered to. In the event of a transfer, let's say an investor wants to sell their shares to somebody else. Well, now the syndicator has to go through all of that process again of due diligence. And most syndicators are reluctant to do that. It takes time, it takes energy, it can involve expenses, maybe a legal review. And so the legal documents may outline a process by which investors can sell their shares, but it's most often going to be at the discretion of the general partners. And it's going to be a discussion between the investor who wants to sell and the general partners to see if something can be worked out.
Great. Next question is, what SEC rules govern the sales of the LP units?
So I believe it's called Regulation D, is the overarching part of the SEC regulations. And then within Regulation D, most syndications are 506B. If you look up 506B, that's going to define the type of syndication that I described in the presentation. There's also a section right after that, 506C, that defines a very similar but slightly different type of syndication involving, 506C the syndicator doesn't have to have a personal relationship with every investor, but it's restricted to only accredited investors. Sophisticated investors that don't qualify as accredited can't invest in 506Cs. So most syndications, maybe I think I've heard 80% are 506Bs and about 20% are 506Cs.
We got everybody get all that 50 this and
Yeah.
all right. I'm going to kind of bundle this question together because we're running low on time. It was the inevitable UBIT question, if there is debt associated with it, and then also the question of 1031s into these deals.
Okay, so UBIT is a very complicated matter. I would say I'm going to just ask you to consult your tax expert to figure out whether UBIT's going to apply. That's kind of beyond the scope of this discussion, and I just don't have enough expertise to comment.
I mean, I would say, yes, it potentially applies if there's debt involved at all. But again, Joel's right. To the extent that it involves you and your IRA, consult your tax advisor. I again, am no expert, but my understanding has been that a lot of the deductions and the things that you're allowed to apply toward it occur inside the partnership. So, it's all how it finally nets out to you as to the impact of what it's going to be. But your tax advisor is the key person to speak to with regard to that.
Yeah. And then to address the 1031 part of this. So that's a very complicated topic. Try to keep it brief. A 1031 exchange is a way to defer taxes when you sell an asset and you buy a similar asset immediately following that. The way it works is you have to sell the asset, have the money collected from the sale turned over to a 1031 advisor or custodian, and then buy a like kind asset. The problem with syndications is because you're not buying real estate, you're buying shares in an LLC. When you sell your shares, when you get out of the syndication, you can't buy the same kind of asset, because the only way you can do that is to go back into a syndication with the same set of people. And so most syndications are not going to allow for a 1031 exchange for that reason. You can't buy what the IRS considers a like kind asset.
Okay. We're running up on the end of the hour, but I do want to see if we can get to a few more of these. One that I think is worth asking, how does the planned Fed increase in prime rate affect the resale of a property?
Yeah, that's a really great question. It's hard to say, because what's going to happen is as interest rates rise, mortgage rates will also rise. So potential buyers of an asset that I own are going to underwrite the money they think they can make from that asset, and it's going to tend to push that money down because more of the cash flow is going to go to their debt. So they're going to look at my asset and say, hey, with my new loan, I can make less money on this. Therefore, I have to offer a little bit less for the purchase. On the other hand, in an inflationary environment, rents are going to trend upward, and values of real assets will trend upward. And so in that same spreadsheet, when a potential buyer is underwriting their deal, they're going to look at their mortgage payment as going up, but they're also going to see the rent comps going up. So those are going to tend to offset. Higher rents are going to mean a more valuable property to them. Higher mortgage payments are going to mean a less valuable property for them. It may end up a wash, but there could be some uncertainty. There could be a difference in the time horizon. Higher interest rates may kick in before rent increases or later, and so there's some uncertainty associated with that. So hard to say what the net result will be.
All right. One more. What's the typical first mortgage LTV?
So most deals that I see on like this are going to be in the 65 to 80% range. Some deals will include the renovation budget in the LTV. That'll be an LTC, loan to cost. Others won't. The bank will only loan on the purchase price, and the syndicator needs to raise the equity directly for the renovation budget. But 65 to 80% is the range I usually see, and 70 to 75% is maybe the majority.
Okay. Joel, we are like literally right at the top of the hour, and we still didn't get to all the questions. But here's Joel's information, his email. People can reach out to you directly.
Absolutely. That's why I put my email there, is to encourage people to, if they have questions or want to follow up and have a conversation, they're welcome to reach out.
All right. Now, there was also some comments in the chat box that some of the slides, I guess for some of the people, were hard to see. Is that something you can make available for folks as well?
Yeah, I can share those. I guess I would give them to you, Steve, and then you can share them out.
Please, that would be absolutely fine.
Okay.
All right. Well, it is just at the top of the hour here, 1 o'clock in Austin. So, Joel, I want to thank you. I think this was a great presentation. We got a lot of great questions and a lot of great feedback in the chat box. A lot of people said they enjoyed it and really got a lot out of this. So, thank you. Thank you all for your questions and your time. And again, remember, check out Quest Trust Company's website, our events page for upcoming events that are both live and virtual. And we will hope to see you again very soon. Thank you very much, and have a great day, everybody. Goodbye.
Thanks, Steve. Thanks, Quest.
Thanks, Joel.